Welcome to a new Smart Money video on the truth about passive income and what it takes to retire early. This video is not about selling a false hope and dream around passive income that so many like to do. Rather, I've spent hours investigating and looking up the details of this to represent it back to you. Not only that, but I have personal experience in creating different assets and income streams which will come to bear. We're going to look to answer some critical questions in this video. One of them being, how much money does it really take to retire on passive income? Now that's a critical question because so many people think with just $20,000 or $30,000 they could retire if they could just get the right sources of passive income. But that's not true. We're not only going to look at how much, but also how. What are the different types of passive income and how you can create various assets which generate income for you in a very passive manner. We will also take a look at the semi-passive. In other words, the things that are not totally passive income but require a little bit of effort and generate a really good return. We're then going to move on to the different phases of creating passive income and this asset engine which generates income for you. And finally, we're going to finish off with an example table looking across the different returns you can get from various sources of passive and semi-passive income in order to have $5,000 per month as a passive income stream. If you like to get videos on finance, personal growth and business, please consider subscribing to the channel. Now, with passive income, there are two different types. There is passive income which is derived from money or an investment, a capital investment into something. And then there is passive income which is derived from effort that has been put into creating an asset. And you do get some which is a combination of both. Passive income is not something that you work at all day. If you have to work at it all day, that's just income for your time. Passive income should take no more than 10% of your time. In other words, it's a little bit of time to manage or market your particular asset to get the return that's needed. So the phases of passive income. First phase is the creation or the acquisition, the acquiring of the asset. And this is really important because you want to select the right thing. You want to choose a niche or an area that you're familiar with, that you have some education with. It is not a good idea just to go and buy shares if you know nothing about shares. It is worth your time to spend effort and even a little bit of money sometimes to get education around the different passive income streams. Now, after the creation of the passive income, you're really looking at either the marketing or the maintenance of it. So if you've created an asset based on your time and skill and knowledge, you're going to need to market that. Help others to become aware that you have created this and this is going to help them and solve a problem in their life. They will then buy it. And then that's how you start to generate income from it. But it's a specific type of asset so that you are not spending a lot of time continually recreating it. Also, if you think about real estate, there is a little bit of marketing required as well as maintenance. As the property gets older, you do need to maintain it. You need to spend some money in upkeep and repairing things that perhaps get broken or things that are old and wearing out. So there is a maintenance phase involved with these assets. If it is stocks and dividends, the maintenance phase is actually about looking over your portfolio and carefully thinking, is this still looking on track to generate the type of returns that I want? Because all companies grow through different phases. Phases where they're really growing and succeeding and phases where they're becoming irrelevant and declining within their categories. So you want to make sure that your stock portfolio is up to date and really strong. So that would be the maintenance phase. So we have the creation of it, we have the marketing, we have the maintenance, and then finally we have the 2.0. In other words, the recreation of the asset. If this is a property, this is about renovating it so that you can get even more rent, or perhaps repurposing it. So you take a really big place and you subdivide it into multiple properties that enables you to generate more revenue that way. If it is the stocks, it's about selecting something better, and so on. We are going to look at that table in just one moment, which is going to compare a number of different passive income streams with semi-passive income streams and how much effort or money is required in order to get $5,000 per month. Before we go there though, I want us to think about some considerations for passive income. And the first one is risk. What is the risk involved with a passive income stream? You see, some people take extraordinary risks with their capital, and they end up getting a higher return. However, that higher return comes at the cost of a higher risk. Now, if this is all the money you have that you're going to be able to live off, is it worth risking everything in order to get that stream of income? And that's something you need to decide for yourself, and each person's circumstances are different. But it is a good idea to ask 3 simple questions to evaluate the risk. What is the best that can happen? What is the most likely thing that can happen? And what is the worst thing that can happen? And if you can live with the worst thing that happens, and the most likely thing furthers you towards your goal in creating of passive income streams, then it's usually a good opportunity. Now let me give you an example of that, stocks. If I was to buy Amazon stock and I said, well, what's the most likely thing that happens? The most likely thing is that it increases in line with the rest of the market around about 6% per annum. However, what is the worst thing that can happen? Well, Amazon can go bankrupt or be filed some lawsuits against it for malpractice and lose a large portion of the stock value. I can put some practices in place which can limit that risk to say 20 or 30% of my capital. So the worst that happens is that I can lose 20 to 30% of my capital. The most likely thing is that I get a good solid return and dividend from the company, and therefore it would make sense for me personally to invest and to get returns and dividends from that particular share. The second consideration is around tax. There's various different forms of tax. You get dividend tax, capital gains tax, income tax, just to name some of them. Now the important thing is if you choose a real estate property, you're going to incur on the monthly rental income tax. And if that is in a company, it's going to be taxed at the business's rate. If that's in your personal name, it's going to be taxed at your tax rate. Now if you're trying to get $5,000 worth of passive income and you're at a 20% tax rate, that means you're going to have to cover the tax amount so that after tax you get the $5,000 out. Now, if you're looking at dividends, dividend tax is often at a different rate to your income tax. And this means that you can perhaps get a lower rate if you optimize your portfolio. The third consideration is, are you going to put money into buying an asset or time and effort into creating an asset? And this is really important. We're going to see in a moment how much time and effort it requires versus how much money it requires to create passive income streams worth $5,000 per month. And lastly, you need to ask the question, is this for me? Is this something that my skill and my education is building towards? Am I understanding and knowing and growing in knowledge around stocks, and does that interest me? Am I growing, knowing and understanding more and more about real estate, and that interests me? Or perhaps another asset, which we will cover in a moment, that you put time into and then it can give you a return. So who you are, what you know, and what you're passionate about is also important so that you can continue to grow. The more education you have and the stronger your skills are, the better your returns will be. All right, now we're going to look at the example of $5,000 per month. What is the amount of money or effort required per passive income stream in order to achieve this? If you're enjoying the video, please remember to hit the like button and subscribe to the channel for more videos like this one. Now, dividends from shares is the first one we're going to look at. And what a dividend is basically the profits that a company makes each quarter or year. They take a share of that and they pay it out to people who own the stock. If you want to find out more about that, I've created a video and we'll link it at the end, which goes into a lot of depth around what dividends are, dividend shares, how to select them, and how to get the very best returns possible. The average return that you can expect from dividend shares is between 6 and 8% for high quality, good performing ones. If you just choose average ones and you randomly chose shares from the stock market and just threw a dart at the board, you would probably get a lot less, 3 or 2%, which is really not a good idea. So spending a little bit of time and effort, getting 6%, that means to get your $5,000 per month or $60,000 per year, you would need a share that is going to pay 6%. You would need $1 million worth of that share. That's right, $1 million is going to buy you a dividend paying share that generates $5,000 per month. Now for some of you that might be shocking because so many have said just buy dividend shares and get passive income and be financially free. It's easy, and it is easy if you have $1 million. If you don't, it's a little bit harder than that. Now remember, you can start now, and the share, if it's a good company, will go up in price. So over time, that'll be worth more, and the dividends will continue to pay, which you can reinvest, and that can increase the value. So taking a 10-year or 20-year view on this makes it a lot easier and more attainable for an everyday person than having $1 million in the bank. Now, what are some of the risks of this? Well, the risk is that the actual share comes down in price. It'll continue to pay dividends even if the price comes down. However, if the company moves from making a profit to making a loss, it is not able or allowed to pay dividends out, which means that you will no longer receive any income from it whatsoever. Also, if a company is making losses, be sure of this, the stock price would have dropped. So the risk is that you can lose 20, 30, or 40% of your $1 million. Passive income stream number 2 is very similar to number 1, but instead of publicly listed companies, it is about investing into private companies or startups. Here you can take as little as $1,000 and become a multi-million-dollar heir. Now, the interesting thing about this is that you might also get nothing back. Most startups and most private companies don't perform that well compared to larger companies that have been listed. The reason people list companies is because it's actually super successful, it's scalable, it's reproducible. So there are some private companies that'll do really well. There's a lot of private companies that are going to do okay, and there's a number of private companies that are going to do badly. So what is the downside? If we ask the question, the risk question, what is the worst that can happen? Well, the worst that can happen is that this thing goes bust. So in other words, it's a much higher risk investment. However, it's going to go up in value. It might just go up in value a lot more, 100 times more than what the stock market is. So there's a risk to reward. Now, that's not for everyone, and it's very difficult to calculate how much money you need. It could be as little as $1,000, or it could be as much as $2 million. So on this one, I can't give a definite answer, but I did want to call it out. Investing in private companies is an option, but it can be highly risky, so you need to be very careful what you do. Next on our table is real estate. And with real estate, here we can see that on average, returns come in between 2 and 12%. Now, in areas where there is rent control, you will find that the return is between 2 and 3%. In other words, the city or the state has imposed certain regulations and laws which prohibit rents from increasing beyond a certain rate. This means that the rentals are kept lower, and it is advantageous to those renting. However, for those who own properties, it is not good, and you're going to get a lower return. On average though, if you avoid rent control areas, you can find places where you get, there you guessed it, 6% back. So the same as what you can get on average from dividends of stocks. And you'll see this pattern gets repeated a few times. 6% back. And that means you need $1 million to get your $5,000 per month. However, if you look towards some other areas where there is a massive demand, the return on investment in these areas, they are between 7 and 12%. If you get the upper end of this, 12%, instead of needing $1 million to generate $5,000 per month in passive income, you only need $500,000 because the rate is twice. Instead of 6%, it's 12%. So you need half as much money in order to generate the same amount of passive income. Now those deals are getting harder and harder to find, but if you continue to look for them and you apply yourself diligently, you might be able to find them and therefore take advantage of these differences in the market. The risk with real estate is again very similar to that of stocks. You might lose a little bit of money, say 20 to 30% of your initial investment as the market comes down or if a particular area starts to go bad. However, if you are spending time on maintenance, as I suggested, the value of your property can be maintained, and not only maintenance but also evaluation. Evaluation in terms of looking at what is the area like, is this still a good area, is this area in demand, is the population in the area increasing, and all of those good things. That enables you to evaluate the property and understand, does it have a future potential in the next 3 to 5 years that looks good? If it does, then you know that the property prices probably won't crash unless the whole country has a recession, which is then going to be about 3 years of prices being suppressed and rentals maybe coming down a little bit. However, it should pick up once the markets change and the recession is over. The next one is lending clubs. Now, what is a lending club? A lending club is basically an organized or structured way of coming together to create microloans and different loans. If you buy into a lending club, you are able to get returns, again, between 5 and 7%. So the average sits around 6. So if you choose a lending club, it's going to require, again, $1 million. So basically, you start to see a trend here that you need about $1 million across different sorts of passive income, which are generating 6% return per annum. The difference with a lending club is that your actual asset doesn't change in value. So in other words, with real estate and with stocks can go up in price, and the underlying asset can be worth more every single year. And the same thing with a property. Every year, the property prices in general go up, and therefore your asset is worth more and more every year. When loaning money, however, you only receive the interest due to you, which is between 5 and 7%, and the asset, the amount that you loaned, stays fixed. So it has that disadvantage. The advantage here is that unlike with stocks and unlike with real estate, you can get started with much smaller amounts. The risk with a lending club, however, is that everything goes wrong. The composition of loans, you have multiple defaults in a recession, and you actually end up losing significant amounts of your money. So the downside risk is much larger. So you do need to evaluate that. The final passive income, before we get to the semi-passive incomes, is certificates of deposit and money market accounts. Now, typically they perform plus minus the same over a 10-year period, and you're looking at currently getting between 0 and 2%. So right now they're not great because interest rates are really low. If interest rates start to increase, they become more attractive. And if you're in a country where interest rates are much higher, 10, 11, 12%, then certificates of deposit and money market accounts are going to be more attractive than some of the other asset classes. So you do need to check for that. Now, what is the risk on it? The risk on a certificate of deposit and a money market account is very, very low. Unless the institute itself or the country defaults and goes bankrupt, highly unlikely if you're choosing a reputable institute that's been around for a long time. That means that there is very low risk to your money. And it is much safer than putting it into real estate or into stocks where prices can fluctuate or go down, or into lending clubs where you may get nothing back at all. So at a 2% return, you're looking at needing $6 million. So at a 6%, we needed 1 million, and at a 2% return, you need 6 million to get your 5,000 passive income stream per month. Okay, we're now going to look at the semi-passive income streams. We're going to look at ebooks, we're going to look at YouTube, and we're going to look at blogs. For ebooks, this is really tricky to calculate, but something to bear in mind is how much do you earn per hour or per year? Because if you're earning a lot of money, say $400,000 per year, and you spend 3 months making an ebook, that's really a $100,000 investment. If you're earning $120,000 a year and you spend 3 months, that's a $30,000 investment. Now I say 3 months because creating an ebook is actually a significant work and amount of time, and 3 months is really not a lot of time. Now you can create an asset. Not only do you have to create it, but remember there are marketing costs, and people will on average need to experiment to find out what the acquisition cost is. Some may pay as little as $1 to acquire someone buying it, or as much as $100 if it is highly specific and niche, because advertising is more expensive the more niched it is. So unless you already have an audience, you're going to have to spend on advertising. So ebooks are a bit complex and a bit more difficult, but know that you need to take your time and how much your salary is per year into account in order to work this one out. For a blog, this is very interesting. There are multiple ways to monetize a blog, and you're looking at affiliate marketing, you're looking at sponsorships, you're looking at advertising, and perhaps you're looking at selling your own products or merchandise, ebooks on your blog. Now, I analyzed a number of different blogs that have published their results, and what I found was this, that it ranges from anywhere from $10 per 1,000 page views up to $120 for 1,000 page views. The more technical and specific it is, the more the cost goes up. Related to financial products, the more the cost goes up. However, the more technical and specific it is, the more niche it is, and the page views come down. So it is a little bit of a give and take here in finding the balance. However, the amount of effort required is that you would need to create a blog where you get between 50,000 and 500,000 views a month in order to generate $5,000 per month in passive income. And if we jump over to YouTube, this is very interesting. If we were to go on ad rates only, it is quite difficult to reach 5,000 per month, because what you are often finding is that per 1,000 views of a video, if you've monetized it, you can get between $2 and $10. A few sites get more than $10, but that's pretty much the range, $2 to $10, which means you need to get 500,000 to 2.5 million views of your videos each and every single month. Now, to create a YouTube channel of 500 to 2.5 million views is not a passive income. You're not just going to do that from a 5-minute video. You're going to be spending hours and hours creating videos. So this is definitely a semi-passive one. Now, importantly, not only do you rely on ad revenue, you also have affiliate links as well as sponsorships, merchandise. So all in all, the rule of thumb is, in order to get round about 100,000 a year, which is more than what we need, but if you adjust for income tax, it probably hits you spot on the 60,000 off the tax. So in order to get 100,000 a year, you need about 100,000 subscribers, because out of those 100,000 subscribers, you want to find 1,000 subscribers which are loyal and focused on what you're producing and will buy it. They will each spend about $100 with you a year. Thank you for watching the video today. I hope that it has been interesting. The link now on dividend investing should be up, and you'll be able to click that to find out more. If you've enjoyed the video, please remember to hit the like button and subscribe to the channel, and share this video with someone, because together we can create an abundance.